When it comes to making money passively, the first thing that most people come up with is to invest in the stock market. But for the layman, exposure to the stock market is mostly a long term investment in fundamentally strong stocks, be it through a direct investment or via mutual funds. In today's video, we will look at the other spectrum and discuss about a stock market trading style called swing trading. We will also try to learn two widely used swing trading strategies so you can make some short-term capital gains in a time frame of a few days to a few weeks. So let's get straight into the video. Let's first understand what is swing trading. Swing trading involves buying a stock with the aim to hold it for more than one day and selling it in the near term, that is a few days to a few weeks, until the target price or the stop loss is reached. The objective of using swing trading is to capture the short-term price movements in a stock. It relies heavily on technical analysis in order to identify when to enter and exit the market. Now, before we start discussing about the strategies, it is crucial for you to understand the advantages and the disadvantages of swing trading. One of the best advantages of using swing trading is that it requires less time commitment. The reason being, swing traders rely heavily on technical analysis and they do not have to look at the fundamentals of a stock in order to make a trade. The second advantage is that this strategy helps to capture the bulk of price movements in a stock in the short term. Coming to the disadvantages, there can be sudden market swings overnight. If the market swings are huge, you may hit the stop loss. Now, contrary to this, there can also be stocks that can have a great upward swing that is much higher than your target price. In case of such stocks, you can miss out on the exceptional gains. Let me show you an example. As you can see on your screen, you might set a target to sell a stock X at rupees 100, which is currently trading at rupees 95. Say the stock price increases from 98 to 110 on a single day. Then, due to the target price set at rupees 100, you would miss out on the 10 rupee gain from 100 to 110. So these were the advantages and disadvantages of using swing trading. Now let's discuss about the popular strategies that traders use. The first strategy is called the bullish pennant pattern. In a bullish pennant pattern, a strong positive sentiment by the bulls causes a significant upward move before the pattern. This upward move is called the pole. The buyers that have pushed the market higher then book profits, and at the same time, the bears sense a potential of a slight pullback in the stock's price, leading to consolidation of the price. During the consolidation period, which typically lasts between 1 week to 3 weeks, the resistance and support form a symmetrical triangle as shown on your screen. One should note that the support and resistance do not move in parallel because then they would form a flag and not a pennant. Also, when the support and resistance form the converged lines during the consolidation phase, a trader can notice that the volume of the stock being traded has fallen down. At this point, it becomes imperative for the trader to be alert and keep an eye out for a breakout so he can open a position in the market by setting a stop loss and a target price. Now, a question that might arise in your head is, how do I know if there is a breakout? Well, when the stock price has consolidated, there are traders waiting to buy in the market and hold a long position in anticipation of an upward price move again. Traders therefore look for a sudden hike in the volume and the stock price piercing through the resistance level to move upwards. This is when the bullish pennant pattern is confirmed. Let's understand with the help of an example. In the chart on your screen, we can clearly see that a bullish pennant pattern is forming. Now, pay close attention as we are going to look at the entry, the stop loss and the target price. Let's say the stock price crosses the resistance line and the high of that particular candlestick is rupees 110. Then in that case, your entry in the market would be slightly higher than the previous day's high, which is 110. So your entry in the market could be at 111 on the next trading day. Also, say the support on the converged lines in the pennant lies at 106. Then you will have to put the stop loss at rupees 106. Now, most traders use the 2:1 risk reward ratio, meaning that a person is willing to lose 1 rupee in anticipation of a profit of rupees 2. In our case, since the entry and the stop loss have a difference of rupees 5, therefore our target price will be the entry price plus 2 times rupees 5, that is 111 plus rupees 10, which comes out to be 121. So as soon as the stock price would reach 121, the target price would trigger and you will have a profit of rupees 10 per share. To give you a real life example of a bullish pennant pattern, this is the stock price chart of Pidilite Industries, where you can clearly see the entry, the stop loss and the target price. Now, another popular swing trading strategy is the 44 moving average. The 44 moving average tells us the average price of a stock traded over the past 44 days. It is an ideal moving average to identify the short-term trends in the stock price of a company. When using a 44 moving average to make a trade in a stock, there are two prerequisites which you must keep an eye for. The first prerequisite is that the 44 moving average should be upward moving. And the second prerequisite is that the stock price should reach near the 44 moving average and a green candlestick should form. This would be an ideal scenario to open a position in the market. The reason why this strategy works is because an upward spiking 44 moving average acts as a support for the stock price, and a stock price near the 44 moving average has a high probability to bounce back higher again. Some experts also use the relative strength index to make a trade, but we'll keep that explanation for some future video. On the chart on your screen, you can clearly see the stock price movement as well as the 44 moving average. Now, you need to identify when the stock price moves close to the 44 moving average line. In our case, it is the 15th of January. So you will have to place an order on 16th of January at the high of the candlestick, that is rupees 221. Your stop loss will be the lower of the last two candlesticks, say 210 in our case. And finally, the target price following the 2:1 risk reward ratio will be the entry price, that is 221 plus 2 times the difference between entry and stop loss, that is 20. So the target price will be 221 plus 20 being 241. To give you a real life example of using the 44 moving average strategy, you can see on your screen the stock price chart of Cipla Limited. You can clearly see that as soon as the stock price reaches closer to the 44 moving average line and a green candlestick is formed, we have opened a position in the market by setting the entry, the stop loss and the target price. So these were the two popular swing trading strategies. With practice, one can learn to identify these patterns on the daily time frame chart and make some decent short-term gains on a regular basis. Thank you so much for watching. Like the video, hit that subscribe button and stay tuned for my next video.